Hey guys, welcome back to Father and Son Investing. Today we're going to talk about April 29th and May 1st, why those two dates are important if you are a bond or bill holder for the U.S. government, and how those dates are kind of flying under the radar right now. So let's get started. Now, in order to talk about this in a sensible way, I'm actually going to back up to January 29th of 2024 to this press release from the U.S. Treasury. This is the Treasury announcing their marketable borrowing estimates. They actually do this every quarter. In this case, it happened on January 29th, and then on the 31st, they issued their quarterly refunding statement where they break down bills versus bonds versus notes and how much of each. So this Treasury announcing the marketable borrowing estimates will occur on April 29th, and then on May 1st, we're going to get the quarterly refunding statement. So these two pieces of information are going to make a huge difference in what your Treasury bill, note, and bond yields look like. But they're kind of flying under the radar this week because really people were expecting the GDP announcement this morning. We'll talk about that in just a little bit. And the PCE announcement tomorrow morning. So let's just touch on this. Why did I back us up to January 29th? It's this paragraph here. During the April to June quarter, Treasury expects to borrow $202 billion in privately held net marketable debt, meaning they're going to borrow in addition to what they're going to be paying back, $202 billion. So don't think that the Treasury is only going to be auctioning $202 billion. They're going to be auctioning far more than that, but they're going to borrow $202 billion. Also, as part of this paragraph, note here that it's assuming a cash balance of $750 billion. That goes into something called the Treasury General Account, and I'm going to show you some important information, some interesting information about that Treasury General Account, also known as TGA. So this seems like a lot of money here. The Treasury is going to, at least they're anticipating, we won't know until April 29th, borrowing $202 billion here. But just how does that compare? It's always important to be able to compare to the past. Now, if I take you back to last year at this time, of course, we were dealing with the debt limit crisis. But let's just go back to last year, 2023, and compare. So this is the January 30th, 2023 announcement here. And if we go down to this same paragraph, they anticipated borrowing $278 billion. So the estimate for what would be happening for May to June is actually less than it was this time last year. But let's just go back a little bit further. Here's the January 2022 marketable borrowing estimate. And when we look here, we see that for April to June 2022, the Treasury was only going to be borrowing $66 billion. So that gives you some idea of what this has looked like in the past. If we go back to prior to that debt limit crisis, only $66 billion is what the Treasury was going to be borrowing, and they assumed a cash balance of $700 billion. So let's just talk about this cash balance in the Treasury General Account. What has that looked like? What does it look like now? And what does it look like in the past? So I went ahead and made up a little graph here, a little PowerPoint slide, showing what the Treasury General Account balances have looked like. Now let's just go back here for some reference. So if we go back to January of 2023, that's really when that debt limit crisis was kind of kicking off, and the Secretary of the Treasury, Janet Yellen, had said that the Treasury would run out of money probably sometime in June-ish, maybe out to July. And so back then, when we look at the account, it had about $450 billion. These are in millions over here, so about $450 billion. Now, if we get down to just before Congress essentially put away the debt limit, kind of crazy, they just got rid of it totally, but we had gotten down to about $23 billion in the account. Now I'm going to show you a little bit to get an idea of how does that $23 billion compare to the past. And then since then, without that debt limit, the Treasury just started borrowing money like crazy. We see that they kind of got that account balance up to about $600 billion, and then they have since gotten it up even higher. So what does it look like now? Now we're out there about $970 billion is what the Treasury has in its checking account. You can think of this as the checking account. This is what the Treasury is going to pay its bills from. Now, if you remember, I pointed out that for that January announcement, they estimated that what would be in their checking account would be about 750 billion. So right now they've got about 200 billion plus over what they were expecting. So let's go ahead and back up just a little bit further in time, just so we can get a feel for what this Treasury General Account has looked like in the past. So this is going to run us back to about January of 2007. We can see that back then the Treasury General Account, it was running around 4 billion, 5 billion, 6 billion was all it had in it. So compare that to how low we got in January of last year, that $23 billion. That actually seems like a sizable sum when you look here. We get into that financial crisis kind of time period, and we can see that it balloons up a bit. It got up to 84 billion in there, but still far less than 100 billion. And we don't actually get out to where the Treasury General Account has this 100 billion or so in it until 2013. It had about 200 billion in it. The Treasury account now has about $970 billion in it. Why is the Treasury holding on to so much money? So I have a theory behind this, and my theory goes like this. I think that while the debt limit has been suspended, the Treasury is just essentially stockpiling money. So the question will be, what are they going to do with this surplus $200 billion that they have in their account? Remember, they estimated that there would be $750 billion at the end of this quarter. What are they going to do with that? Are they going to go ahead and borrow less to bring that general account down to $750 billion? Or are they going to try to hold it at about $970 billion? Or are they going to try to increase it even a little bit more? Well, I'm going to go ahead and make my prediction as to what I think the Treasury is going to do with its quarterly borrowing estimate. So I think that they're actually going to borrow less than this $202 billion that they were anticipating. Why? Because I think the Treasury is going to try to sell this as, hey, look, we're borrowing less than we estimated we would. That always looks good, right? But we're going to compare that to 2 years ago when they were only borrowing in the range of $60 billion, so that we realize just how much money they are still borrowing. So I think the Treasury is going to borrow less than the $202 billion. I'm going to throw out $150 billion as a number, and that way they can say that they're saving $72 billion. And I think they're going to try to keep that Treasury General account up. I think they're not going to let it dip below $900 billion, and that will sort of reset the bar in terms of what the Treasury General account has. I think they're aiming for probably more than $1 trillion in there by the time the election rolls around. Because remember, after the election is when that debt limit is going to come back into play. And I think the Treasury is going to want to have a whole bunch of money stockpiled in there so that when Congress starts fighting about this debt limit again, they have plenty of money to spend and keep funding the government. Remember last time at about $450 billion is where Janet Yellen was saying somewhere between June, July-ish, possibly out into August, depending on how they were spending, they could continue to fund the government. Well, with a kitty of more than $900 billion, potentially $1 trillion in that account, they can continue to fund the government for quite a while. So what does this have to do with your Treasury bill, note, or bond yields? Keep in mind that this is going to look drastically different than it did for their quarterly announcement in January, where they're talking about borrowing $760 billion. So I don't want you to see this potentially what I think will be about $150 billion and thinking, oh my goodness, the government is just borrowing so much less. No, the government is borrowing so much more still, so much more than they were in 2022 at this same time period is my prediction. With the government borrowing more, that should drive yields higher. Now, will they go higher than they went today? What happened today? There's this headline from MarketWatch: 2-year Treasury yield pierces 5% after quarterly PCE inflation comes in hot. That's a little bit confusing because it's the quarterly PCE inflation and not the monthly PCE inflation, which will actually come out tomorrow. But let's just take a peek at this. You might think that if GDP is slowing, that's going to bring bond yields down. That might be the initial response. GDP came in at 1.6%, which was far less than the 2.2% that economists were estimating. So why then are bond yields going up? Well, within that GDP report, it also talks about the quarterly PCE, and that came at 3.7% annualized. That's up from 2% in the fourth quarter of last year. So that's up significantly, and that is what's driving bond yields up today. Let's just take a look at that. This is the 5-day graph on the 10-year Treasury note. You'll see this big spike here shooting up to 4.729%. It's since retreated back just a little bit. That's what's happening with the 10-year Treasury. Let's take a look at the 2-year Treasury note. That also took a nice spike up. It went up over 5%. We'll see now that there's a few times here in April where it's gone over 5%, and it has since retreated back to below 5%. 4.925% is where it's sitting as of this taping. So what can we expect for the April 29 and May 1st announcements that will be coming from the Treasury? Those, again, are the quarterly borrowing estimates and then the refunding statements. What can we expect will happen with yields there? Well, I think personally that when the April 29th announcement comes out, that we may see a bump going up in note and bond yields, not so much Treasury bills, because those, again, are really closely tied to what the Fed funds rate is. You may see a bump in the 1 year. That has certainly come up significantly in the last month or so. On May 1st, when that actual quarterly funding statement comes out, I'm not quite certain yet what's going to happen there because it depends what the Treasury decides to do with notes and bonds. This is what the quarterly Treasury issuance looks like. This, again, is quarterly, so we'll see that this last quarter here, over $7 trillion is what the Treasury issued. This is what the public debt maturing within the next year looks like. In fact, it's a record $8.9 trillion worth of treasuries, so about a third of what the U.S. debt is set to mature in 2024. Why is so much of this maturing? Well, it's because the Treasury has been keeping the issuance of notes and bonds artificially lower and issuing more Treasury bills, trying to keep those rates down on the 10-year Treasury note, because so many things are based off of that 10-year Treasury note. If you have a mortgage, that's going to be based off the 10-year Treasury note. So they're trying to keep that down by artificially keeping the volume down, and thus they have to issue more Treasury bills. Well, these Treasury bills, the longest one is 1 year, obviously, and so there's a lot of debt that's going to be maturing here. The question is, will the Treasury stop keeping these note and bond issuance artificially low, or will they keep that Treasury bill issuance up and have to deal with this turnover in the debt and not really knowing what their long-term interest rates are going to be? So what do I think personally the Treasury will do on May 1st? I think they're going to continue to artificially keep those Treasury note and bond issuances lower than they should be. Now, they're already, though, at record highs. Just the other day, the 5-year Treasury auction was a record high. So even though they're trying to keep these artificially low, these are still record highs. It's just that they should be even more record high. So I said I think that there will be a bump in yields on April 29th when the Treasury announces this. Keep in mind, this is what I think, they're going to sell it as, hey, we're going to be borrowing less than we estimated, but know that they're still borrowing a huge amount. That is what I personally think is going to happen. What I personally think they should be doing is saying we've got $200+ billion more in our account than we should have, what we estimated we would have, and we're going to go ahead and start paying that back instead of borrowing more. But I don't think the Treasury is going to do that. On May 1st, what do I expect? Again, that one I'm not quite certain on, but I think we might see a little bit more of a bump still in what the yields look like as the market starts to digest just exactly how much the Treasury is issuing. So that's my report for today. Hope you learned something in here, like Treasury General Account and just how much money is in there. If you learned something new, please give us a thumbs up. And until next time, enjoy your investing.